Good afternoon, good afternoon, good afternoon. This is Antoine Smalls of Financial Blueprint. Thank you guys for continuing to support the channel, continuing to tap in with me. We are back again for another stock market live on Friday. And I'm so glad and so thankful for me being able to do this platform and be able to do this every week with you guys to give you a fresh set of eyes on the stock market and to go over a bunch of topics every week as we continue to invest in the market. We continue to invest in our future and ultimately invest in ourselves, right? So as you have seen over the last few weeks, we've had a lot of data points, a lot of reports that has come out. Unemployment has went up. We've just received another CPI report, which is the Inflation Consumer Price Index report today. We're going to go over, I'm sorry, that was yesterday. We're going to go over that today, and we're going to continue to take in all this information as we continue to grow in the stock market, as well as learn the current economic updates, macro as well as microeconomics. What I want to, implore you guys for today is we got a whole bunch of things to take a look at, a whole bunch of topics to talk about. Continue to support the channel. Dive in, hit the like button, subscribe to the channel. Leave me a comment what you think about the current state of the economy, housing market, unemployment, as well as inflation data. So let's go into the first report. We have our CPI report, which was yesterday. Consumer Price Index was reported yesterday morning for the month of August. Let's go into the CPI report right now.
And Telly are here for what we should get on time, and that is the CPI. Rick, you got it? Or Steve?
Up 0.4% versus an estimate of 0.3%. Real earnings minus 0.1%. Obviously, the inflation number's taking that off. Let's see what we got here. Year over year, headline 2.9%, right in line. Ex-food and energy 3.1%, right in line. No adjustment to the prior number. But the one thing is the headline. The core at 0.3 is exactly in line with estimates. Let's see what else we have here. Unadjusted. That's all I have right now, Joe. How's food was up 0.5%, so some pressure there. Food 0.4%. Owner's equivalent rent 0.4. A little bit of pressure right there. I don't have the actual table yet, but I'll get that in a second. Taking a look, see if the bond market is reacting at all. That's what Rick would be telling us, but he's going to be here in a second. I still have the 2-year at 351. Rick, do you remember where it was going in? I can't remember. 10-year at 4.01. So that's actually down a bit on this number. Yeah, pretty big decline. I think market's seeing essentially, Joe, this inflation numbers in line with expectations. Okay. The key here, and I'll dig into the numbers, I expect to find tariff inflation in there. The key all along, the main risk to all of this was it going to spread to other things? That does not appear to be the case. That was the risk that held the Fed back. We can argue, did it make sense for the Fed to guard against that kind of risk?
Is this a big moment, Rick? Is that
263,000? Is that what I'm seeing on initial jobless claims?
I didn't see that, Rick.
Yeah, 263,000. That is the news of the morning. We haven't been above 250,000 since October of 24. So 260,000, where's that going to comp to? It equals where we were in June of 23. To find a higher number, you're back to October of 21. To me, that's the biggie. We're talking about, is the Fed fund futures market going to potentially price in 50? That is your catalyst to actually get there.
To price in 50. Where's the 10-year, Steve? I was thinking we might get a 3 handle.
10-year coming up. 4. That's what the market's reacting to.
Exactly,
not, 4. Not the inflation number.
Exactly, 4.
We're waiting for that under 4 number. Your buddies in Chicago, listen, who have the calls on that part, right?
So let's stop it real quick. So a couple things, right? We've seen the first report. CPI was reported at 2.9 year over year, 3.1%. Estimated, it followed the estimated guidance that the street wanted. The interesting thing about CPI is the Fed wants a 2% interest rate environment. I'm sorry, a 2% inflation rate environment, right? So being that it's 2.9% year over year, 3.1% in the month of August, that is not a positive report for the inflation gauge that ultimately the Fed wants to continue to go down, right? It's like an escalator, right? A small, slow steps down, like you're going towards your basement, right? Down the steps in your household. You want inflation to continue to be moving in a downward, way. From a chart perspective, you don't want to see it continuing to hover above what they would want, which is the 2.0% inflation, right? While at the same time, you have this initial jobless claims. So if you look at this initial jobless claims report, it says 263,000 initial jobless claims in the month of August, which is a lot higher than the estimate, which is 234,000. So what the gentleman is stating is this is the highest initial jobless claim number that we've had in a very long time. So this is very alarming because this is an unemployment situation, right? So we've talked about the unemployment rate going up to 4.3% as of last week, when they did the payroll report, and we talked about how the Fed's mandate when it comes to unemployment, lower unemployment, is very important currently in the current economy that we live in, because there is a higher level of unemployment that is being shown over the last few months, right? So we know that unemployment then impacts homes, it impacts families, it impacts the economy as a whole, it impacts spending, it impacts businesses because it then impacts spending. So this is an all-encompassing issue. So the Fed, being at the Fed's meeting, we'll talk about that later, the Fed meeting next week, and their possibility of cutting rates is very, very high. These are all reports that are very important to what the Fed is going to take a look at and then make a judgment call on how much they want to lower interest rates next week. We are at 100% interest rate cut. The street is expecting 100% 25 basis point cut, as well as a possible 50, but more than likely it's going to be a 25 due to the jobless claims as well as the payroll report that we had over the last couple of weeks.
The 4th of, April, when we had our 3.99 yield close, the low close for the year for 10s. In Chicago, everybody was betting that we were going to spend a lot more time under 4%. I took the other side of that. I think debt deficits matter. I think the yield curves matters. So I still say, even if we close, and it's based on a close, and a weekly close is your highest priority from a technical perspective. And once we get that, I think if I was a trader, I'd probably still end up fading it. I think if the Fed cuts 50, the yield curve steepens 25. I still think 10s are going to be there, and they're going to be stubborn.
So it's important that we pay attention to the 10-year Treasury. This is the what I would call the most important gauge of interest rates is the 10-year, right? Now, mortgage rates don't follow the 10-year, correlated directly with the 4% of what you see currently right now when it comes to the 10-year. It's a gauge, though. So as the 10-year comes down, mortgage rates then come down to what they're currently sitting at, which we'll go over in the future. Future in this live stream, we're going to go over housing and mortgage rates because they have come down also, right? So when you start to see the 10-year Treasury yield come down, that is good for not just the stock market, but also for the housing market when it comes to interest rates. So these are all little things that we need to pay attention to when it comes to rates and interest rates, as well as the Fed, and how all of these things tie into our investing journey.
It makes me upset when I see everybody talking about 30-year bonds. 30-year bonds haven't been the biggie in over 20 years. And just because the UK and the Japanese, they trade those things by appointment, it gets distorted. Arbitrage keeps it in line. But you want to watch the 30s versus 10s spread, 5s versus 10s, the fight, the knob, because the steeper these get historically, the more that tells me that the premium in between these maturities is going to keep getting wider and wider.
Rick, I want to just cut you off for a second because I want everybody to take a bit of a chill pill here on this jobless claims number. I'm trying to run it down. There was a spike of 15,000 in Texas, and I don't know why that is. it could have been some kind of special sort of thing of, it could have been in local education or something like that. But if you back that out, it looks a little less drastic.
Traders don't like backing anything out of the garage. They look at everything in there, whether you have jalopies or limousines. It is what it is. These numbers have never been accurate. And I think that they're going to pay a lot more attention.
That's what I was going to ask. These numbers, the revisions that we've seen, how much attention do you pay to this the first go around?
Our Treasury Secretary really kind of nailed it. And it made me a little nervous because basically he said it's not about maybe, tweaking how we do the numbers. It's now becoming a case for how do we need to reform the Fed? And his logic is almost very hard to refute.
So that is the initial breakdown of the the CPI report, as well as the initial jobless claims for the month of August. Now we take a little bit more detailed look into how that CPI report and jobless claims is impacting the stock market and the Federal Reserve next week. Let's take a look at that really quickly.
Inflation reading today. It is the biggest month-on-month and year-on-year increase for CPI since January. CNBC senior economics reporter Steve Leishman joins us this morning with some new ways of looking through these numbers. Hey, Steve.
Hey, Carl. Yeah, welcome to our new augmented realities set here. Talk about this firm inflation number that the Fed is expected to look through because of the gathering concern about the labor market. But this spike in jobless claims may be partly seasonal, as we'll come back to that in a second. Here's the data right here, up 0.4. That's a 0.2 higher than last month. That raised the year over year 2.9% versus 2.7 in July. Looking at the core, right in line, but still somewhat elevated here, 0.3 on the month over month, same as July, and then 3.1, same as July on the year over year. But now take a look at some of the internals here. Auto repairs up 2.4%. People holding on to their cars maybe a little bit longer. You can see down there in the bottom right, used cars up 1%. Tool appliances, a little bit of a tariff effect there. And airline fares up 5.9%. I thought that was a little curious, given that we've had some decline in the in travel here. Now those jobless claims numbers, big spike, but went back and looked, you could see it's from 236 up to 263. But a lot of that, folks, if you look at the next screen here, Texas up 15,000, maybe some adjustment when it comes to the start of the school year. We've seen spikes in this week back the last 3 years. What's the market do with all this data? Let's put it together. Take a look at the Fed fund futures. September, 100% with a 10% chance of a 50. Not much change on today's data. October, 92%. And then December, you can see right there at 85%. So good confidence of 3 rate cuts this year.
Oh, let's take that back. Because this might be a problem if inflation continues to stay elevated, right? They are expecting, and the stock market as a whole, the market as a whole is expecting 3 rate cuts, right? One in September coming up next week, October, 92%, as well as December to end the year at 85%. So this is saying that more than likely they're expecting, and the expectation is 25 basis rate cut September, October, and December. That would put us at a 3/4 of a point rate cut, right? 0.75% to the Fed's fund rate that we currently are sitting at right now. That would lower interest rates significantly when it comes to not just mortgage rates, but just rates overall in general. When it comes to you going to a bank, you buying a car, and any type of loan that you're basically looking at getting from a bank, right? So this is very important. However, if inflation stays high and the employment situation cools down a little bit, then the Fed is going to have to make a decision on if they want to continue to lower interest rates or pause, right? So the key is not just taking the cut and running with it. The key is listening to what Jerome Powell, which is the federal chair, is going to report and say in the meeting next week when he does the press conference. What does he say? Right? Does he say that, we lowered interest rates because we have an unemployment issue, but we still have sticky inflation due to tariffs and other variables. So we're going to wait and see for future guidance, or does he say that for future guidance he sees a possible rate cut in October as well as December, for what we're basically expecting over the next 3 months, right? So it's not just about the report, it's also about the guidance moving forward, and that will also play into the stock market and how the stock market continues to rally, or if we see a small pullback in the latter month of September.
With a 10% chance of a 50, not much change on today's data. October 92%, and then December you can see right there at 85%. So good confidence of 3 rate cuts this year. Want to show you one quick chart here. We look at the core commodities versus core services. Look at the next one here. Folks, I'm sitting in an augmented reality set, and let me tell you, there's a bit of a difference here. I've yet to find an economist who is really happy about these numbers. You can see here that core commodities have gone from a negative, a drag down on CPI. Now they're a positive. That's likely tariff effect. Hopefully that's temporary. Core services a little sticky at a 3.6%. Market looking right through it. Economists say this is not the inflation report of their dreams, guys.
Right. So how does the Fed handle it? I mean, clearly the market is expecting that the Fed will just keep cutting rates and they'll be more worried about the labor market right now. And there's plenty of reason to be concerned about the labor market. But how do you think that discussion on inflation goes?
Sarah, my wife and I danced to a John Hyatt song at our wedding many years ago called Have a Little Faith. And I think that's what they're doing. I think that is the essence of monetary policy right now. You're having a little faith that the tariff inflation or the rise in price from tariffs will pass through, that you'll have this spike in some prices. And because people are spending more for the essentials they need there, they'll spend less and have downward pressure over on the right side. That's the faith. I think the other way they're thinking about this, Sarah, and you also know this argument here, is that since they are modestly restrictive, they can come down a bit, come down maybe a bit more, 50 basis points, still remain restrictive and be putting downward pressure on prices still at a higher level. What that does raise questions about, though, are those 3 rate cuts and the broader outlook for the market for 3% on the Fed funds rate or a neutral rate getting back there quite so quickly. So the disagreement may not be this month, may not even be next month. It's a little bit more down the road, but the Fed doesn't have to make those decisions right now.
Wow, so that's a good report when he's basically saying that the Fed could decide to lower interest rates, temporarily to, they're at 4% right now. It could be let's do 3.5. Let's say September and October they low 25 basis point each month was give us the 3.5, and they can then sit at 3.5 for an extended period of time. But that is when the conversation and the disagreement between Fed officials as well as our president and the economist starts on should they continue to lower rates after October or December into 2026, or should they wait, right? And so what's going to have to happen is we're going to have future CPI reports. We're going to have future PPI as well as PCE reports, which will then obviously show if inflation is continuing to go down or not. We will have more job reports, payroll reports that will tell us about unemployment to see if the United States economy is continuing to go down a little bit. Should we be concerned about unemployment? If we're not concerned about unemployment, then you could easily see the Fed hold and not lower rates any lower. So we talked about CPI. We talked about the initial jobless claims and the impact of those things. Now we're going to talk about how those things impacting the mortgage and the home side of things, which a lot of people are interested in trying to get into the home and buying a home, first-time home buyers, things like that. This is an opportunity for, if you're a homeowner or if you're looking to buy a home, this is an opportunity for you to take advantage of what we have lower interest rates coming up and what we're going to see next year when it comes to the housing market.
Yield fell below 4% for the first time in 5 months. This comes less than a week before the next Fed decision. Joining us now from the Zelman Housing Conference in Boston is CNBC senior real estate reporter Diana Olick. Diana, great to see you. What do you make of this drop, and what could 25 or 50 basis points in cuts next week do to the mortgage rate?
Well, Melissa, despite the two economic indicators we saw this morning, we only saw mortgage rates drop 2 basis points. So we're now at 6.27%. But inside the room across from me, you have hundreds of home builders, mortgage lenders, investors, land developers, and Ivy Zellman, one of the great analysts, putting up 87 slides literally on the state of the housing market. And what she pointed to was really that affordability as the main headwind and how that translates into mortgage rates buy downs. What she said was that 72% of the builders are now buying down mortgage rates. And she said that 1/2 of those rate buy downs are more than 100 basis points each. And that is going to continue to put pressure on builder margins. So the question is, how much longer can they do that? Because even though rates are considerably lower than they were just 6 months ago, you don't know that next week, if the Fed lowers rates, are mortgage rates going to pop back up a little again because they've already been priced in so early?
So this is important, right? So we have a 30-year fixed mortgage. As you can see it on the screen, is at 6.2%, right? And in some cases, you can get it as low as 6%. If you're going to go trying to, get your credit down, credit up to get yourself in a position to be able to go to a loan officer to purchase your own home. She also stated that builders, if you're going to a new construction builder, the communities that have builders, the builder will buy down your rate to 5% and possibly even lower to get you in a good interest rate environment when it comes to a mortgage rate, so that your mortgage is not nearly as expensive, being that the interest rates have been elevated over the last 2 years, right? So this is good, so if you're looking to buy a house, you're looking at 30-year fixed, at 6.27%. This was as of, I think, yesterday. FHA is a little bit lower. You can get it down to 6, maybe in the high 5s. And then if you want to go to a new builder, new construction, you could possibly get it down to 5%, which I think is actually really good. So all of these things then play into, buying houses and real estate. And this is also really good information for the average American, so that they can then go and put a loan, to apply for a loan to possibly buy a home.
Melissa?
So if they're buying down 100 basis points, does that mean that the mortgage that somebody's getting, if they're buying one of these new builds, is around 5%?
Yes, it is. And that's how the builders are getting their buyers in the door. And, it's a lot of talk around here also is how much the builders are prepared. If rates do come down even more, do they have the supply? Now, we look at the supply of both new and existing homes, and it's very high right now because a lot of the builders, namely D.R. Horton and Lennar, have been doing a ton of spec building. That is building without a buyer as opposed to just buying on demand from specific buyers. Some builders think that's the right strategy. Some don't. I spoke to Ryan Marshall here. He's the CEO of Pulte. He says that is not what he thinks is the best strategy because you could get holding the bag on a lot of these homes if people still can't afford them. So the question is, do builders keep putting holes in the ground when they don't have the buyers? Is that the right strategy? Or is it better to be a little more perhaps conservative on the construction?
So that's new home supply. And at the same time, you have really rising secondary supply out there. And, it's really a funny moment in the housing market in a sense, because you have that supply issue and then affordability is the real problem. So does that mean that price resolves this at some point?
Not yet. Ivy does predict that prices will go negative nationally very briefly next year and then rise again in 2027. Whether that happens, she said she's still not even sure about that because, again, it's these pressures on who's in the market. If you look at supply specifically, the supply is actually on the low end, you have sales being the lowest and supply the highest, which means that the low end buyer cannot get in even to that low end home. And so that supply is really high. On the luxury side, you see more buyers, but you see far fewer homes available for sale, which again pushes those prices higher. And if you really have the higher end buyer, the only action in the market because the lower end is still renting, then you're going to see prices continue to go up because that's going to be how the median shows.
Diana, thank you.
The inflation reading today. It is the biggest month-on-month. And
That was key. I don't know if you missed that last part. It was so key to what she was saying was the issue that we have in the current mortgage and the current housing market is you have a first-time home buyer that can't afford the entry-level house. An entry-level house might be depending on where you live, it's all based on location. Obviously, if you're in New York City or California or like Boston, the housing prices is extremely high, right? So we're not talking about those locations. We're talking about the average, right? So if we take the first time home buyer has to pay, let's say $250,000 to $300,000 for an initial home for your first house, right? Is a 2 to 3 bedroom house, maybe 1 or 2 bathrooms. Those homes are too expensive with the current mortgage rate, as well as the rate, unaffordability when it comes to the housing, price. They can't buy those houses. And then you have a large supply of those homes with not a lot of buyers. But then you have the really expensive houses, which you would call the luxury or the condo or the second home for people that want to get out of their first home and then want to elevate to their second home. You have a insanely high amount of the price level being really high. And then you have a lot of people in that looking to buy those homes, right? But you have a lower supply of those homes. So supply demand then impacts those prices. If you have a low supply and a higher priced home, let's say $500,000, $600,000, but then you have a lot of buyers in that, then that breeds competition, which means that those prices, the demand of those homes go up, which means the price of those homes go up, right? And this is an area that I'm personally in, to trying to get trying to either build a home next year or try to buy an existing home that is already priced out at $500,000, $600,000. So that's the tough aspect currently in the housing market. And the lady said that we could see a small pullback in prices for houses next year, which again could be 2 to 3%, which is not going to impact the market, not the stock market, but the housing market that much. It's just going to ease a little bit when it comes to asset appreciation next year. And that's not going to make a huge difference when it comes to the housing market, right? It's not a crash. It's just a cooling down phase. But then in 2027, when you start to see mortgage rates continue to come down through 26, you're going to have a whole lot of new buyers, which means that prices then are going to get elevated again, right? So real estate is not, an easy play. I say buy, when you have the opportunity to buy, and we're going to continue with real estate and talk a little bit. Let's see what they got to say about real estate some more after the mortgage rates have come down a little bit.
Hitting their lowest level since last October. And that's giving a boost to home builders. D.R. Horton, Toll Brothers, Lennar, Pulte, all up more than 2% today. For more on what's next for the housing trade, CNBC's Diana Olick joins us from the Zelman Housing Summit in Boston with an exclusive interview with Ivy Zelman. Diana.
Thanks, Melissa. Ivy, it was your day today. What an amazing day. Hundreds of people here to hear everything. I'm going to take you back to 9 a.m. where you had 87 slides on the state of the housing market. But the most interesting one to me was where you said that home prices will go down next year before coming up again in 2027. How do you see that?
Well, it's really a tale of two geographies regionally. We have geographies that were the COVID winners, and now they're decelerating as we're seeing net migration under pressure, even lower in some states than it was in 2019, as well as really elevated resale inventory. And the inventory is then being pushed, even prices being pushed lower because the home builders, their market share has grown so much in those markets. They've oversupplied the markets with spec. So when you add that, lastly, employment, you're looking at those markets that will be pressured. Whereas the other side of the coin are markets in the Northeast and the Midwest that were COVID losers that are seeing improving that migration. Inventory is kind of still well below COVID levels, and employment that's actually holding up. So what we're looking at are really all in prices we think in 26 that will be down about 0.8%, barring affordability doesn't improve dramatically.
But, you focused on affordability, and let's talk about the builders specifically. They've been buying down mortgage rates aggressively. Your number was 73% of builders, and more than half of them were buying down by more than 100 basis points. So if they're lowering rates into the 5% range already, then we see see rates come down even more by the Fed, perhaps, then you're having affordability is improving. Yes, doesn't that send many more people into the market and therefore push prices higher?
Well, the builders have been pretty much offering mortgage rate buy downs when rates started going up in 2022. So today there are 1 to 2 years as low as 2.99, 3.99, and then for the remaining 30 years left, they'll do 4.99. So they've already been making it a buyer's market, providing very good value and affordability. So the real question is, will they keep providing mortgage rate buy downs as mortgage rates prevailing come down? And I think they will, because
but it's hitting their margins. I mean, he said it.
But the margins will be less impacted because it gets less expensive as rates come down. But they have a lot of spec inventory, and it's not like wine. It doesn't get better with age. So they're motivated sellers, but the velocity that they want to keep sustained is going to be driven by the incentives. And while it might, on the margin, decrease a little bit, I think they're going to stay very active with buy downs.
So she's talking about how builders, and what I mean by builders, if you go to Ryan Homes, for example, or Lennar, if you go through a community that's a new construction builder, they'll have deals where she was saying for the first 2 to 3 years, you'll have let's say a 2.99% mortgage rate. And then after the first 2 years, for the rest of the 28 years and a 30-year fixed mortgage, you'll be at a 4.99 interest rate, right? Environment, right? So that's better than going out and buying an existing home from a bank and you having to be at, even where we're looking at currently right now on the screen, is 6.25% on a 30-year. The builders are incentivizing you to be able to go and buy a new construction home in their community, right, by giving you a lower rate. And that is basically them taking on the interest that comes with the current buy down, which is 6.27. So they're taking on that money, right, from a business perspective. And it hurts them short term when it comes to, their earnings, their revenue, as well as their profits, specifically their margins. But if they got to get these homes off the lot. If they're buying what she will call specs, if they're building specs and they're already built, like you see houses that's already sitting there, but they'll have the, new construction sign, which basically means that no one's living there. They got to get someone in the door, right? So they have spec homes available, already built for someone to walk in the door and say, hey, I want to buy one of these homes. I go through the underwriting process. I put in, my income, all that good stuff. Underwriter says yes, and we walk into our house, and that's our home, right? So this is an opportunity for people to go in at a lower rate, being that it is a buy down and that the builder is offering these rates instead of going and buying an existing home for an elevated price at the regular rate, which is currently at 6.27%.
But you bring up spec homes, and there's been this kind of argument here because you showed that D.R. Horton and Lennar are 100% in on spec homes, and you said, I think that's the right way to go. I talked to Ryan Marshall-Hulte. He said, I don't think that's the right way to go.
Well, think about this. If you're worried about the job losses accelerating and builders are speccing, they're providing the consumer a mortgage rate buy down. If you do a build to order, you can't do a mortgage rate buy down. The timeline to close, call it 6 to 12 months, it's too expensive to take the forward commitment risk. So if in fact you think you want to get growth, build to order might be under much pressure. We have builders that are going into 26 with backlogs down 30 to 40%. Wall Street won't like it if they're not going to grow. Now, if you think the economy is going to get better, because rates are coming down and job losses won't be a concern, then obviously pricing power will come back to the market, and Ryan Marshall on build to order could be right. So it's really where you stand on the economy. But I think builders that are speccing are doing so because they want to offer mortgage rate buy downs and provide new move-in ready, which was demanded during COVID.
So you cannot offer, and this is what she was saying, a builder cannot offer a buy down if the spec isn't already built, right? So if you're doing, like, for example, I want to go to a builder and ask them for I want to get blueprints. I want to provide them with blueprints. I want to have them be able to build my home. In that situation, you can't get a buy down in that situation due to the fact that those aren't already built homes currently, right? So what some builders are doing is they're just building. They're building model, spec homes. They're offering buy downs to be able to get customers in the door. And then people being able to just walk in houses that's already pre-built and being able to just use that as their home. So that's a little bit into the housing market. When it comes to mortgages, as you can see, mortgages came down to 6.27%. We know that over the last, 6, 9, 12 months, I mean, we've seen mortgage rates at 7%, a little bit over 7%, which is a very high rate in the most recent housing market. If you're, someone that was in the housing market in the 80s and 90s, obviously interest rates were a lot more higher. So that's not as high to you. But for the new homeowner, 7% is pretty high. And when you've had a 0% inflation environment, interest rate environment in 2019, 2021 timeframe, then sitting at 7% is considerably higher than where we've been in the past. All right. So we talk CPI. We've gotten into the housing market. Now let's take a look at how these things are going to impact the stock market moving forward and how we need to position ourselves in the current environment moving forward with the Fed coming up next week.
And more market exuberance, all but guaranteed. Tim?
Well, we've priced in a lot of market exuberance, and really even after the V-shaped recovery from Liberation Day, we've done probably almost 10% on the S&P, almost 12% on the NASDAQ. And it's interesting, you're talking about the Dow today. We kind of sometimes make fun of the Dow as an index because we think it's the way it's calculated makes less sense to me. That's not what we're here to talk about. The point is that small caps, equal weighted, Dow, so not semis, not the high end of the tech outperformed today on this sense that you really got reaffirmation from some of the data. The data being a bizarre jobless claims number. Excited to talk to Rick Santelli and get his interpretation of some of that. But I don't think today's CPI was a great number if you're someone that wants to see inflation tamed. I mean, I think we actually saw some goods inflation that's seeping through. I think we know that services inflation is sticky. I think we have a higher kind of inflation paradigm right now, better than at least higher than where the Fed wants to be. And I think all the liquidity that have markets going to the moon right now, and that's almost every market, especially even credit, is something that should give the Fed some pause, even though the labor side of the mandate, we all know, is getting all the attention right now. So markets have priced in a lot of Fed. I think markets have priced in more than the Fed that we now have in terms of Fed fund futures. And I think that's something to be somewhat wary of. But what a week when you think of all the earnings revisions, I think, that are coming for the tech sector based upon all the news we've had over the last 5 days.
I mean, I think the question at this point is are the markets pricing in too much Fed? I mean, you take a look at the inflation numbers. Are you somebody out there who buys groceries, gasoline, electricity, and repairs your car?
Yep.
Well, then you see inflation, and that's an issue. I mean, that's a problem for the Fed.
It's a problem. I mean, the macro is about as confusing as it's been in a very long time. You look at that June jobs report that's been revised lower. That was the first one, I think, since COVID, right? And then if you look at the CPI and you look at some of these other inflation readings, you have to kind of take into account like the cumulative nature of, this inflation is the thing. So if you have a weakening jobs market and you have inflation starting to move higher, that's a really tough spot for a consumer.
This is a current picture of inflation in the month of August for CPI and each specific sector or variable that played into the overall inflation gauge. And as you can see, you have shelter at 3.6%, which is mortgages and rent. You have food, which went up 3.2%. For groceries, you have gasoline actually came down 6.6% over the last 30 days or so. And as you can see, continuing, because this is a theme that we've had over the last couple of years, is used car prices, used vehicle prices have went up even over 6% in a month, right? So this is an inflation gauge, and you see all the way to the left, you have the overall inflation went up 2.9% month over month. So that's something that's concerning, because we know that the Federal Reserve, inflation number that they want inflation at is 2.22%, basically, right? So we're still well above that 2% threshold. So this is something that we need to watch over the next couple of months to see if inflation is going to stay up, if we have tariff inflation, or if inflation starts to continue to come down.
Is already dealing with some of these increased prices as it relates to the tariffs and the uncertainty and how long we're going to actually be in a trade war. I mean, you got to think about this. We came into this year, it was 2.5%, basically that tax across the board. And here we are, it's about 18%. So the, as it relates to the market, though, I think, Tim, what he just said is like, there's one thing, though, that's actually working in the stock market in the S&P 500's favor is that we see the dollar can't get out of its own way. And this whole notion that we're going to be in a rate cutting cycle, that should be a bit of a tailwind. And then you just kind of throw in this CapEx that we've seen, again and again and again. The numbers are so huge. And I think it was Apollo's Torsten Slot had this slide last week. And I think we talked about it 2 weeks ago. If the consumer's 2/3 of GDP, right? Well, that CapEx has just matched that number. So that's been a huge, huge tailwind. So if you do start to see a pullback in that and a weakening consumer, there's little doubt that you're going to be in a situation where it's going to start getting back to that R-word recession. We haven't heard that in a very long time.
I go a different angle. I go jobless claims. So jobless claims the worst in 4 years since October 2021. If you have a job, you can pay inflationary prices. Shelter costs, 1/3 of the CPI. Think about the chicken and the egg. If the Fed lowers rates, you wind up having lower mortgage rates. You wind up having lower CPI. Right? So for me, they're enforcing that higher CPI by not cutting rates. So if you could cut rates, 1/3 of CPI comes down. 1/3 of CPI comes down. Then you throw in transportation. You have gas coming down, used car prices. Why aren't used car prices moving down? Interest rates. So you have mortgage rates, interest rates for used car prices. Everything that the Fed is doing is fostering higher prices by keeping prices where they are right now. So double mandate, I'm looking at the job side more importantly.
That's very important. And this is why I say that economists have different thought processes and believe different things when it comes to the debate on how the Fed should operate and if they should lower CPI. They should lower interest rates moving forward. It's not just in September and this month, next week, but also in October and December. Right. So what the gentleman was saying was if you have a higher interest rate environment, that then impacts mortgage rates, which then impacts housing, right? As well as cars, right? Because you have a higher inflation. You have higher interest rates. That means that car prices stay elevated. And that is a double whammy, right? So if you lower interest rates, then you would assume that mortgage rates come down, housing comes down a little bit, as well as interest rates come down on houses, on cars. If you're trying to get a car, which then lower the prices for used cars, right? So that's a good way of thinking. Not everyone believes that, right? But that is how some economists and some analysts feel when it comes to the Federal Reserve and if they should lower interest rates, and then how many basis points should they cut, right? Right now, we're pricing in a 25-point basis cut. Some people think it should be 50. And then moving forward after September, after next week, we could see additional rate cuts in October and December. All right, so we're going to continue looking at the stock market and how in this current environment, interest rates as well as CPI and inflation and everything is impacting the stock market. Let's go to the committee and see what they got going on currently today.
At record highs. Notable today, the 10-year yield near the lowest level since April. So we're watching all that with the Fed meeting on tap. Will they go 25 or will they go 50? That seems to be the biggest question because the market is convinced nearly 100% you're going to get at least 25. So Weiss, the question is, what do stocks do? That's question number one for today. JP Morgan's trading desk says this could become a sell the news event. I've heard that from others as well, because the market has continued to ramp up, today notwithstanding, ahead of that meeting. What do you think?
So I think there's a real possibility, but it's not going to turn the rate cut. If we get 50, the market takes off. 25 is a base case. I think that, and what JP Morgan's saying is that that's in the market right now. I agree with that. However, it's going to turn on what the narrative is.
That's right.
That
Powell's
Powell comes
words.
out. Yep.
Powell's words more than the numbers are
Absolutely.
probably what matter more than anything right now.
Right. And look, it's clear from the numbers that jobs are going away. Claims are high. Job growth is low. It's basically flat. So they're going to decide what is going to move the most. Is it going to be inflation continuing to spike up? And then they have an out. That's tariffs. It's a one-time event. So I actually think they're going to be somewhat dovish, when they go next week.
Okay, how about a dovish 25 cut? That great for the market?
I think it goes up. I think it goes up.
Yeah, Bryn, what about you? How do you game this out?
I think we get a 25 basis point rate cut. 50 doesn't seem to be necessary. I think we get a 25 basis point rate cut. They acknowledge the weakness in the jobs market. I think he's definitely going to get questions about the data itself, right? The 911,000 revisions we have. So I'm really going to be curious to hear how they thread that needle. I think that the market, once again, is a pull forward mechanism. So we already have this priced in. I don't think we're just going to get some rip roaring rally. I think what's been working will continue to work. And so I think you're going to have sectors like real estate, private equity, et cetera, that will continue to be these beneficiaries of a lower rate environment. And I don't think we're going to be one and done.
I've heard, Rob, for, I don't know, like 2 weeks that it's priced in. How can it be priced in if the markets continue to set new highs? Maybe it's not priced in.
Well, there's a little bit of positioning there, too. If you look at institutional investor positioning, we're in the 58th percentile, which Deutsche Bank would define as decidedly neutral. So I agree with Steve. I think it depends on the communication that comes out with it. But it's also what the data informs from here. So short run, you might get a move. But then what does the data inform from here? And I think if the data doesn't lean towards a direction of further cuts, not a disaster where you're seeing growth that completely roll over, but just leans towards the ability to have further cuts, given the moves in stocks, given the move in specifically small caps, treasuries, gold, you could see a re-rating that's maybe more substantial. I just don't think so, because as we go into the fourth quarter, I think you're going to see a pretty big positioning chase from here. It's more next year.
Okay, that's what I want to get into. I tease it up perfectly. Like the best rate cut, right? We think we're going to get a cut, 25, 50, whatever. Your best positioning for a cut. Do you stay big or do you go small? Russell 2000 is on pace for its sixth straight week of gains. Small caps are having their best quarter since the end of 2023. The NASDAQ's up 14% year to date, and the AI trade, as you know, has been back on lately. Stay big or go small post rate cut between now and the end of the year. What do you do?
Well, I always stay big, so I'm a little bit less objective than some of our friends here.
Okay, well,
So what are they talking about? They're basically stating, should you stay big, meaning large cap stocks, right? Microsoft, Nvidia, Amazon, Apple, Nvidia, said Nvidia already. Google, big companies, Tesla. Should you stay big, right? Go with the big players, right? Netflix, etc. Or do you go small caps? Right now, small caps is in the Russell 2000, which is why they showing the Russell 2000 on the screen, right? But small cap stocks are a little bit, more volatile. They do well in a low interest rate environment, and they tend to run when interest rates come down versus when they go up. Those companies, those businesses struggle, and it's really based on the fact that those companies' profit margins are either they're either profitable or they might not be. They might not be even profitable companies. They have low profit margins, which then impacts their businesses as a whole. So, which is why there are more risky plays when it comes to the stock market. But some people believe that with the lower interest rate environment, those companies will do better. So the transition from large cap to small cap could be something that might be in play moving into next year. This is the debate and the playbook when it comes to economists as well as these analysts and these fund managers on how they then allocate money. They move them from Nvidia or from Microsoft or from some of the big players, and they then reallocate them to some of the smaller cap companies so that they can see that continued growth moving forward. This is important when it comes to your investment portfolio and if you should diversify or not. I say stay with the 3 to 5 great companies that you believe in, reinvest, accumulate more shares, and ultimately, get the long-term benefits long-term.
What do our friendly viewers, what should they do?
Follow me and stay big, because the challenge is moving forward, to Steve's point, if the data breaks down, then you're going to see the small cap, the more speculative side roll over.
Even with rate cuts, if the data breaks down?
I think so, because you're betting on a stronger economy. So here's the thing about the sell the news, because I thought that was a really interesting note. If we get a 50 basis point rate cut, I think that would be a sell the news event, only because from my perspective, it could be a little bit scary. Like, why do they need to do that? I'd rather see it be more of a cool glide. Like, give me 25 now and a few more 25s. 50 may spook the market.
Man, I don't
It
know.
would spook the market very short term.
Consumer sentiment came out negative today.
Yeah, but I still think 50 takes it higher. Whatever the knee-jerk reaction is, it's so tough to account for. Usually it's a head fake.
How would you answer that question? Stay big or go small? We're
I
thinking
stay
about
big.
outperformance now, right? Not what we like, this, that, and the other.
Yeah.
Outperformance between post-cut and end of the year.
Look, I would stay big because I think it'll continue to work. And if you take a long-term approach rather than trying to buy the smaller caps here, the smaller caps, they're going to be hit a lot harder by a slowing economy. And that's what we're seeing.
But why then is the Russell up 5% over the last month if the data has been showing that the economy and the job market is slowing? Well, wouldn't that be one of the leading indicators in the market that agrees with the data?
Well, these are new markets. So generally, yes, but generally the small cap starts moving, and some of the junk, I'm not saying small cap's junk, but we've seen that move also. And that typically moves. They're the last ones to move. So as you look for what's not participating in the rally over the last few years, it's small cap. We've had some head fakes on small cap. So it's a catch-up trade.
Well, you just said small caps are the last ones to move. We both know that generally speaking, small caps are the first ones to go in and the first ones to come out.
Go out, right.
So, but they're not the first ones to go in because they're not going in. They're up 5% over the last month, even in the face of data that's been a little squirrely and job numbers that just flat out haven't been good, right?
Understood. My point is the dynamics. Let me just finish the thought.
Yeah, go ahead.
But the dynamics in this market, unlike any other cycle, they just are, because everything that's in index funds, because retail investors aren't really selling much on news. Some are, and creating those bottoms. But overall, people are adding to it. We really haven't seen that, while we've all been in the business. So over the last few years, it's changed. So that's what's affecting small caps.
Well, to your point then, so maybe there's full positioning towards the mega caps. And if it's 50, people say, well, I mean, there's going to be a huge bang for your buck in other places of the market finally. And then you get a rotation.
Listen, I'm not rotating out of nothing. I'm telling y'all this right now. Listen, NVIDIA, Microsoft, Google, Amazon, Meta, Netflix, the AI plays, the TSMs, the AMDs, the Oracles, like not transitioning and rotating out of those names, right? Like, I'm not taking profit out of those names. I'm going to continue to reinvest to buy more shares of great companies for long term. This is not a short term play. This is a long term perspective, right? This is a 10, 15, 20-year thought process, right? So be very careful when you're starting to listen to some of the commentators speak on rotating out and, re-diversifying into X, Y, and Z. Right. They don't tell you that you got to pay taxes every time you sell a position. Right. So every time you make money, you make a profit. You have a process. You sell. You have that transaction that takes place. Then you got to pay taxes on that. Right. And you have short-term capital gains tax that you have to take in consideration when you're making these moves. Right. So I say on every single discount, you see a 5% discount. You see a significant red day, a red week, right? Because it will come over the next couple of weeks into a month time frame until October. At some point, we're going to have some type of pullback. I say buy those companies at a discounted price. take a look at the charts, take a look at your technical analysis, and be very specific and execute at a high level when it comes to buying the shares of great companies.
Why would that happen? Because for 3 years, there's been very little in the way of refis for these small caps. They're dependent upon capital markets. Large caps aren't. So
yeah, right. Rates going down and capital markets already picking up is good.
And I think that the small cap that's going to go out and refi that needs money, the cheaper money is better for the small cap. So we've seen it. Whether that trade,
we've already seen it. Rates haven't even barely budged.
We've seen the move in the small caps.
It depends on the follow through from an economic standpoint. Period with small caps. If you get follow through, which means that you're cutting in a benign scenario, small caps will continue to run. They will continue to do well.
Aren't you kind of doing that now? Aren't you kind of cutting in a reasonably benign scenario?
But you're
still hanging in there.
That's why I talked about that intermediate thing, Scott. If the labor market continues to break down and the consumer fundamentals get worse, that indicates further economic deceleration. And I think small caps have a tough time with that scenario. So I think we're waiting for data right now to confirm the pace of the slowdown. How dramatic is it going to be? We personally don't think there's going to be a recession, but small caps have run so much here recently that I think the safe playbook is what these guys are talking about, because remember, the highest quality parts of the index are being driven by AI data center demand that is still robust. You saw it through Oracle. All those trends are very powerful in place.
That's fair.
And this is speculation as to whether we are going to be able to get that economic acceleration with rate cuts.
That's fair.
And you're going to be able to perfectly engineer that handoff of the baton from the one to the other.
All right, 30-year mortgage rates hitting
That's
their
a
lowest
fact.
level since.
That is a fact. His last statement is it right there. That's it. He said, don't be speculative. He said, go with the facts. Don't just assume that we're going to and try to time the market to where you think that stocks in the small cap realm will just automatically just come back and continue to rally. They've already rallied to what they currently are. And I'm looking at the S&P 500 right now. We hit another all-time high today, right? So we moved up from a SPY perspective to 659.11, which is a new all-time high. This is very, 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 you got to be very, concerned, not concerned, but just, feeling a little weird because we are rallying into a Federal Reserve meeting next week. And that we're going live on YouTube next Friday to talk about the rate cut and how the stock market reacted. When they say sell the news, we're talking about stocks usually, at times, will rally into a news. A news report could be a Federal Reserve meeting. A news report could be earnings. A news report could be a lot of different things, right? Apple does a conference every year. NVIDIA does a AI conference. Stocks will rally into an event, right? Which would give you a lot of momentum upward to the event. But when the news comes out and when the actual data comes out, when an earnings report comes out, when a conference is happening, when the Federal Reserve chair is speaking, there is a sell the news event where people then take profits. Depending on what the news is, you have, fundamentals that will move money away from one position and then reallocate it to another. Next week is quadruple witching, which means that options will be canceled out and sold on next Friday, which is very important for you to know if you are a trader. Usually when it comes to quadruple witching, you have a 2 to 3 day period of selling before Friday and then possibly after, right? So be careful about your trades next week. Be careful about this rate cut. You might have a sell a news event, which people will then sell stocks on the news of the rate cut. You could see a rally, right? There's all these different possibilities. It's just being aware of what's happening of what the situation looks like and how that impacts you and your portfolio. Right. So today we spoke about the CPI report. It's still elevated. The Fed has to pay attention to the inflation gauge, obviously, right? We have how mortgage rates are then being impacted and coming down because of the 10-year Treasury percentages coming down when it comes to rates. We have the upcoming Federal Reserve meeting coming up next week, which we will be live on YouTube next Friday to show and give you a inside real-time script on the Fed meeting and the rate cut and how that impacted the stock market. And then last but not least, we have how the rate cut environment will impact the stock market and then how the market will react to it. As I always state, man, subscribe to the channel, hit the like button, continue to support the channel as we continue to progress in our financial journey. We got a bunch of new things coming out over the next couple of weeks and the next couple of months. I'm very much excited for what's to come. But I want to continue to pour into you. As I always say, invest, 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 invest. Today is Friday. Y'all got paid today, right? I don't get paid till next Friday, but some of y'all got paid today. Don't go out here blowing your funds. Don't be out here blowing your money on stuff that really is not important. Put money into the market. Put money into your brokerage account, 10, 20, 30%. What you can afford, put it into the market, allow it to grow. If you don't have an emergency savings account, put that in an emergency savings account. Always put money aside for you and your future. Invest in yourself first before you put money towards anything else, right? So we are done today, this Friday, man. I hope y'all have a great weekend, man. I got Canelo this weekend on the fight against Bud. I love Bud, but I got Canelo this weekend. Have a good weekend. I'll talk to y'all next week. We live on YouTube again on Tuesday talking about a topic. We'll get to that. And I love y'all and I appreciate y'all. Continue to be safe. Have a good market. Invest, invest, invest. This is Antoine Smalls with Financial Blueprint. I'm out. Have a good weekend. Peace.